A stock split is a corporate action where a company issues additional shares to its existing shareholders, resulting in a proportionate increase in the number of shares. This action lowers the price per share, but doesn't change the total value of the investment. The purpose of a stock split is to make shares more affordable and accessible to a wider range of investors, without altering the company's overall market value. While stock splits might seem straightforward, it's important for investors to understand their potential effects and navigate the aftermath wisely. One common reason for a stock split is to reduce the price per share. When a stock's price becomes too high, it can deter potential investors. A stock split addresses this by making shares more affordable, increasing trading activity, and boosting liquidity. For example, a company with shares priced at $1,000 might implement a 2-for-1 stock split, doubling the number of shares each shareholder owns while halving the price to $500 per share. Stock splits can take various forms, with the 2-for-1 split being the most common. Other ratios like 3-for-1 or 5-for-1 are also possible depending on the company's strategy. Despite these changes, the proportion of ownership for each investor remains the same, meaning the total investment value doesn't immediately change. The primary effect of a stock split is psychological. The reduced stock price often makes shares appear more attractive, potentially increasing demand and driving the price higher. However, this increase is due to market perception, not the stock split itself. Investors should remember that a stock split doesn't equate to a fundamental improvement in the company's financial health. While stock splits can create opportunities, they also carry risks. Lowering the price per share dilutes the value of each share. In large splits, the increased share count can flood the market, causing short-term declines in value. Investors should monitor the company's financial performance to determine whether the split is a positive sign or a red flag. Stock splits can also affect perceptions of a company's growth potential. A company that splits its stock is often seen as successful and in demand. However, the split doesn't alter the company's fundamentals, so investors must continue to evaluate financial performance, management, and long-term prospects. From a tax perspective, most stock splits are not taxable events. Investors don't owe taxes on the additional shares, but should track their cost basis to ensure accurate tax reporting when selling shares later. Consulting a financial advisor or tax professional can help navigate any implications. For long-term investors, stock splits can be a chance to reinvest dividends or buy additional shares at a lower price, leveraging increased liquidity to grow their investments. However, staying focused on long-term goals and avoiding decisions based on short-term price movements is crucial. In conclusion, a stock split affects the number of shares and their price, but doesn't change the overall value of an investor's holdings. Its impact depends on factors like market sentiment, company performance, and economic conditions. By understanding stock splits and evaluating their potential effects, investors can make informed decisions and optimize their portfolios.